So yesterday we had a pretty big green day, right? Markets adding $4 trillion in 10 minutes just off of a headline coming out from Trump, basically pausing tariffs for 90 days for countries that haven't retaliated yet and giving them kind of room to negotiate while at the same time increasing tariffs on China, going up to now about 124% tariffs on China, which basically sparked a rally in the stock market and all the equity indices, the Nasdaq, the Dow, Russell 2000, S&P 500, and so forth, right? And we saw basically the indexes post in one day or in 10 minutes like a 10% return. We had the semiconductor stocks also perform quite well, right? We saw a lot of semi stocks up 15-20%, right, after that headline. So, a couple of factors here. First things first is that relief of some sort of pause was taken in a good way from traders, causing them to come in and buy and hit the buy button while the markets were basically selling off aggressively on fears. And when you have that scenario with possible circuit breakers being close to hit, and fears and people not coming in and playing the markets or people shorting, it just creates this massive blast off move up higher where you not only have buyers coming in, short-term traders and hedge funds and whatnot, but you also have people who are short get their stop losses hit, causing more buying frenzy, and basically the equity markets just going up like a rocket ship, right? So we had that yesterday, and then basically what we're seeing now, we got the inflation numbers at 8:30, and inflation numbers came in much lower, and the reaction in the markets wasn't the best, right? We're seeing right now, as you can see behind me, stocks a little bit in the red, pulling back. Russell is more under pressure than the other equity indices here, but they're all down. The Dow, the Russell, Nasdaq, S&P 500. We're seeing oil also come down lower, the yen pick up a bit, and bonds, which you would think would pick up more of a bid. We're seeing more of the shorter term bonds move up than the long term, right? We actually saw some selling of the long end bonds on the CPI data, right? So the CPI data, which is basically an inflation metric of how inflation is doing in the US, and we got the March CPI data, which basically came in lower than expected. So the month-over-month number, core month-over-month number, came in at 0.1% versus the 0.3%. The year-over-year core number came in at 2.8%, lower than the expectation of 3%. And the headline CPI came in year-over-year 2.4% versus 2.5%. And here's an interesting one. The headline month-over-month number came in negative 0.1% versus the expectation of 0.1%. Basically hinting to you, telling you that energy prices are basically plunging and plunging and plunging. And we've been seeing that with oil, as there were fears of demand, fears of economic growth, which caused the oil markets to plunge during these tariff talks. However, yesterday we did see oil rally along due to the news that Trump, basically was looking to pause tariffs, and oil went from $57 a barrel all the way to 63. However, we're seeing that retrace now. So we went from 63 and we're down right now at $59 a barrel. So right now, as I'm doing this video, it's about 10:20 a.m. and this is what I'm seeing. Now, Interesting take here is that yes, the CPI numbers came in lower. We had the jobless claims number came in better than expected. So why is the equity markets down? Why is the long end bond, not really picking up the bid? Why is the yen and gold and safe haven assets up? Why is Bitcoin down? What is it? What is it? Shouldn't this be good news that that inflation is coming down and that we got a pause now from from Trump? And not necessarily, because one is you still got the 124% tariffs on China, which is still a bad thing. China being a large trading partner of the US, and along with the other big trading partners like Mexico and Canada, no relief there as well. So it was really just the other countries, the smaller ones that didn't really retaliate, that he put this 90-day pause. Along with that is the fact that you got oil plunging like this, the fact that you got the headline CPI minus 0.1% here is hinting towards demand fears, growth fears, right? So we can see that the markets are, even though you got this pause, they're worried because of how Trump can one day just come up, wake up from his bed and decides to put tariffs, not put tariffs, pause, and cause the stock market to just shake in either direction in trillions of dollars, right? So you can expect the fears and uncertainty around this. So can you say that, okay, with all this information, can the equity markets move up higher? I'll say we'll know. We'll know today at the end of the day, where we end up being, right? Price is your friend. The price action is going to tell you. The bond market is going to tell you as well. And what price currently is telling me right now as I speak here at 10 a.m., it's telling me the equity markets are not happy. They're worried. Even if inflation came in lower, they're worried about growth and whatnot. And the safe haven bid from gold, from yen, and the short end of the bonds is also signaling that to you, and along with oil coming down, also signaling growth, demand fears, recession. Now, the caveat is here, the long end, the 30-year bond, the 30-year yields continue to, we've seen a pullback now after that news from Trump, but we're seeing it slightly pick up a little bit, and it's kind of just staying where it is right now. And what the 30 year is worried about is future inflation expectations, right? So not about last month's inflation expectation. Shrugging it off doesn't matter, right? Future, what's the future going to look like? We heard from Fed members also talk about that they're worried about the future, that we're going to see these long-term effects more heading into the summer. We heard from also Fed members say that we don't want to lose credibility again on inflation, right? We don't want to mess up. Last time we messed up when it came to inflation. We said inflation was transitory and we were wrong about that. This time we don't want to be wrong about it. Therefore, the Fed is in a hard place. What to do? Do we cut rates? Do we ease? Do we not ease? Do we keep rates of where it is? Right? Thus, why we're seeing the Fed sound a little bit more hawkish, and they expect inflation by summer to really pick up here. Thus, why they would hold on rates and stand where it is, unless again you get something breaking by then, the economy just crashing and crumbling, then again they're in a hard spot as well, and they'll probably have to do something about it, which is cutting rates, which is probably just going to ignite inflation again. So let's go back to again this inflation report here, just to cover what came out from the BLS. Basically, the index for energy fell 2.4% in March, as 6.3% decline in the index for gasoline more than offset increases in the indexes for electricity and natural gas. Food and contracts rose 0.4% in March, as the food at home index increased 0.5%. Food away from home rose about 0.4% over the month. The index for all less food and energy rose 0.1% in March, 0.2% in February. In February, indexes that increased over the month also included personal care, medical care, education, apparel, and new vehicles. The indexes for airline fares, motor vehicles, insurance, used cars, trucks, recreational were major indexes that decreased in March. So overall, what they're saying is your food is still expensive. Okay, food at home, food at the groceries, food away, still up there, but it's been the index why it's lower is because it's this these gains were offset by energy prices, right? So lower gasoline, lower energy, lower commodity prices, right? So we're seeing negatives in those numbers there. We also seen used cars and trucks for the month negative 0.7%. So you're getting the cheaper used vehicles. Medical care commodities also down minus 1.1%, and transportation services minus 1.4%, and for shelter still up there about 0.2%. So essentially, commodities, oil lower, used cars, trucks lower, and then everything else like your food away, food at home, and shelter still up there. And this is a telling sign, when you look at this, that the consumer is hurting because essentials like food and shelter is still up. Yes, energy prices are down, but money is flowing towards there. And also with all these tariffs and uncertainty and the high rates and the long end yields continuing to as they were moving up higher, that also creates strain to the consumer as it affects the mortgage market as well. So demand is definitely affected when you read this report and when you see things. What's going to be interesting is how this plays out with tariffs, the changes that the Fed and other people are gonna what they're gonna say. I already saw a couple of changes from Goldman Sachs and their analysts basically changing their views on the economy just because of this message from Trump, the 90-day pause. Anything is possible. It's so volatile. You really don't know what's Trump's next move. But one thing's for sure in this report: demand weakness in the economy is there. It's fragile, and as I speak right now, the long end bond is moving down. Inflation fears there, future inflation expectation fears are still there, still lingering, and you have kind of a bid here in the gold market in yen, while the equity markets are a little bit under pressure here. So I would say caution and cautious, and let's wait till the end of the day. Where's the market? Are we down? What if the market goes back down to where it was, to previous lows? Right? What does that tell you? That tells you that, okay, the market just completely shrugged it off and they don't see, that optimism or euphoria that was there yesterday, they don't see that anymore, and they see bigger problems ahead. So let's see where this equity markets go. When I look at the charts from a technical analyst point of view, we are somewhat close to the resistance level in equities. We haven't touched it. We did pop up quite a bit, but there is still some room for equities to continue higher, to touch the resistance level on the charts, right? But again, right, the equity markets can do whatever it wants to do. Equities and stocks can be irrational longer than you and I can remain solvent. So price action is really going to dictate, and it's going to really tell you what the markets are really going to feel and see here. So let's see, right? Along with the bond market, let's not forget about the bond market, right? That's going to be quite the telling sign here, especially as the yield curve gets back into steepening mode. It was steepening a lot before Trump's message, but we're back into steepening mode because of the long end is pulling back in prices here and the yields moving up. So let's see. Lots to take in and lots to be cautious about. cautious about. All right, see you guys around. Cheers. Bye.